Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. My guest today is my longtime friend, Jay Bowman. Jay is the co-founder of Beyond Storage, and he leads the finance, acquisition, and marketing departments in his business. Jay has been an active real estate investor since 2001. He's a real estate broker in multiple states, and he has extensive knowledge in the evaluation and purchase of real estate investments. He's also a husband and a dad, and he personally holds a large portfolio of residential and commercial assets. So welcome to the show, Jay.
Thank you, Sharon. Thrilled to be here.
I'm excited to have you on today because self-storage has gotten to be a big niche, a big investment strategy for some people. But I wanted to start out and have you tell everyone a little bit about yourself and how you got started as a real estate investor.
Sure. I started in as a retail real estate agent in 2001. Back then, I realized, I'm a big fan of saying I'd love to be paid lots of money for doing very little work. And I really thought that's what retail real estate was back then when I was younger. Discovered that just was not for me. And then moved around a couple times, but ended up here in Louisville and bought my first rental property in 2006, a single family. Since then, I've acquired a number of single family rentals, short-term rentals, some multifamily, and then moved our way into storage as well.
Okay. So you started in like most people in single family homes. That seems to be where most people start.
Yeah, it's an easier. There's a lot more of them. There's easier access to it. You're in competition with a number of people, but there's so many houses that you can try and obtain. Different markets, different price ranges. There's something for everybody when it comes to single family. But at some point, I believe in the evolution of your investing process, you're going to eventually go, oh, wait, I understand something to this nth degree, and I can use that knowledge to level up to a different type of investment. Not everybody starts off with the knowledge just to go, great, I think I'm just going to go buy my first $5 million storage facility or my first $10 million multifamily. That's just not the way that works out. So everybody has to start somewhere, and usually that it's a low entry point into single family residences.
Well, I know the challenges of single family rentals well. I know you know them well, and they come with their own challenges. So was that a factor in you switching over to the self-storage model?
I had been doing fix and flips and purchasing rentals since 2006. And in 2019, I was at a mastermind and I heard this gentleman speak, and he had made a very bold statement. He was exiting everything he had at that point in time, which was short-term rentals and single family rentals in the Chicago area. And he made a statement saying he's exiting everything and pushing all in on storage. And I thought that was very bold because I didn't know anything about storage. And so I went to speak with him, and I notoriously have shiny object syndrome. So I was willing to listen to what he had to say. And the more he spoke about self-storage, the more excited I got. I don't think anybody who does single family doubts the fact that it can be a grind. The construction aspect of it, whether you're just putting paint up, you're dealing with contractors, you're dealing with inconsistencies, you're dealing with properties here and then over here, and the problems are constantly changing when you have single family rentals. And then with the fix and flips, or just fixing them up to rent them, there was just the construction just is always a grind. There's always an issue one way or the other. And I was, after 12 years, was getting tired. I was pretty tired. And so I was looking for a way to use my knowledge that I had and yet still continue as a active real estate investor. And after I heard my friend speak, I stopped him and had more questions for him. And it wasn't an immediate change. About 6 months later, I just happened to see this very small self-storage facility for sale on the side of the road, literally a for sale by owner sign on about a 70 unit complex in Indiana, because across the river, I'm in Louisville. And so I called my friend, now partner, and asked him. I said, "Hey, I don't know how to evaluate this very well." I said, "Can you explain this to me?" This is a different individual who I met at the mastermind. And he said, yes. And we went over it, and he said, "Hey, if you ever want to do something together or you have any questions, just give me a call." And I would say a couple months later, he called me and said, "Hey, there's this deal in Missouri. Do you know this small town in Dixon, Missouri?" And I said, "Yeah," because I used to travel back and forth between Springfield and St. Louis, where I'm originally from, for college. And I said, "I know exactly where Dixon is." And he said, "What do you know about it?" And I kind of laid out that. And he said, "Well, there's been a deal that kind of fell in his lap." And this was in the summer of 2020. And so I always refer to this lovingly as our dating relationship, as we decided to partner on this facility. And it was a dog. It was really rough at the time. Now we look back, and we bought this thing for $310,000. A broker had put it in our lap. Very rough, 150 units plus. And that's the first one we bought. And so that began my transition from single family, student rentals, short-term rentals, fixing and flipping, into solely into going after self-storage and looking to acquire those.
That's the way, though. I think people typically do this. They dip their toes in, they kind of try it out, and often it's almost an accidental thing. Like somebody called you about a deal. So you didn't buy the deal that you was for sale by owner?
No, we left it behind. And I'll refer, Eric was, he just, the smaller deals just are harder to cash flow. We have a very specific niche that we like to close on, and I have adopted his philosophy or his theory and why we want to do that. And I would completely agree. So we like to be able to fence our facilities. We like to be able to gate our facilities for security purposes. We like lights. We like cameras. We want to create a product that, whether in the middle of the woods in a small country town or in the middle of a city, we want people to feel as their goods are secured to the best of our ability. And we've looked at deals that were great deals that we could not gate because of their proximity to roads, and we've passed those deals along to other investors. But we have a very specific philosophy that we look at when it comes to investing in self-storage.
That is so smart. I hammer home branding all the time, and you just hammered home what makes you different. You just nailed it out there. And that is so important, because if you can tell people why in very clear cut, with using very clear cut words, why they should choose you over the guy down the road, then you're going to be the winner every single time. So congratulations on that, because you know your business model, and you know the little things about it, like the fencing and the cameras, and all of those are what make you different. So let me ask you this. If someone says, "Well, Jay Bowman can do this, I think I can do this," where do they start? I mean, if we're thinking about the self-storage business, you have a partner. A lot of people have partners, which definitely makes things easier. But where do they actually start in this journey?
A lot of that comes down to education. So identifying profitable investments in single family as opposed to profitable investments in storage are worlds apart, extremely different. So for example, to simplify it, you can say, okay, in a single family, you can go into any given neighborhood, and if all the houses look the same for apples to apples purposes, you can go, that one sold for 100, that one sold for 100, that one sold for 100. I can buy this one for 50, and I can put 20 in it, and I can sell it then I know that my profit is potentially 30,000. There are difficulties when it comes to construction, but you know how that's going to work. Or you can say, well, I'll have 70 in it. I can do a cash out refinance and my mortgage will be X based upon that information. And the comparables tell me that the rents are Y. And then you have this yield spread that you can adopt. And as long as that yield is wide enough or acceptable to you, you can purchase that property without fear. When it comes to storage, there is some of that aspect, but it's a little more difficult. So I used to have a one-page spreadsheet to analyze single-family rentals that we used. My spreadsheet on storage is about 8 tabs, one tab constantly leading to a change on another tab. And so it comes down to where you are in the town, what your traffic is, what the population is surrounding you, the potential for those people to rent, what are other people renting for, what's the security look like, what's the condition of your house, your facility compared to other facilities, because you can be right next door to a facility, and just like any place else, you can be next door to a very, very nice facility and they're charging $100 for a 10 by 10, but you are not near as nice. The idea that you can charge $100 for that 10 by 10, it would be an error. Maybe you can get 90, but you're not going to get that 100. And you need to keep that in mind because you're dealing with multiple unit mixtures. What is the demand? You could have 1,000 5 by 10s and be like, wow, we're going to rent these for $150, but the demand for 5 by 10s is garbage. And so you've already got a faulty thesis on what is going to actually occur with your facility. And so there's a lot of analysis that goes into storage, and to understand that analysis, it really requires education, because it's not a simplistic design. You've really got to understand what that market is offering you, what your potential operating income is, and then what's the likelihood of you achieving that when you begin to analyze those facilities and your competitors.
Is there an average vacancy rate among self-storage? Is there a number for that?
So everybody loves averages because it gives them I like to tell them, it gives them a anchor point. Mm-hmm. So I'll give the one that most commonly is heard in self-storage, which is how much square footage per person can a town absorb. So you can say, hey, if you have a person in a town, the national average is somewhere between 7 to 8 square feet. So if you had, and I'm going to destroy this, if there's 1,000 people, you're going to need, what is that, 7,000 to 8,000 square feet for that 1,000 person town worth of storage, 7,000 to 8,000 square feet. What we found as soon as I really started digging into numbers, since I handle the analysis side of things, that's just absolute garbage. Averages are fantastic when you want to just have something to hold on to make you feel very comfortable in your analysis. But in reality, within a month of us analyzing a number of facilities for potential purposes, we threw that out. It's an irrelevant number to some degree, because you and I live in a town here in Louisville where there are basements. That's not an issue. We have lots of garages. We have plenty of indoor storage. So when you look at it from that perspective, Louisville has X number of square feet per person. But the moment that you really head further south or you head further west, that does not exist. Oklahoma, we were looking at a facility in Lawton, Oklahoma. They do not have basements in Oklahoma. The soil, the geology does not allow for it. And so to apply a metric that is good for Louisville or Ohio or Minnesota, it does not apply to Oklahoma, Texas, Alabama or Florida, where basements are not there. The same thing can be said for California, Colorado, places like that. It's just not, you just don't find basements. It's just not there. So the storage that a lot of people use for their personal belongings, where we use it here, is not there. So it's not uncommon to see in areas like that 20 square feet per person, 25 square feet per person being a necessity. So the averages just don't apply. So you have to really, storage is a very hyper specific area in that you can look in one town and say, hey, this 10 by 10 will rent for $70, but you go 20 miles up the road to another town and you're going to go, oh, this 10 by 10 will go for 100, simply because the demand is different. Maybe the amount of money people are making or the goods that they're buying is completely different 20 miles up the road, as opposed to the location that you're analyzing. So it's very, very hyper. It's a very hyper local investment.
That makes perfect sense. I have friends that live in a lot of different parts of the country, and many of them do not have basements. They may have a second floor that has a little storage area, but when it comes to basements, they just don't have them. So you're right. I would think the geography, the demographics, I can see where all of that would play into this business, really much more than single family homes.
Absolutely. You can, it's not that doesn't apply to single family, but there's so much single family in an area that it's not hard to determine what something's going to rent for.
Yeah.
You can go into any given area and do a mile radius, and you're going to have, I don't even know how many houses, 100 plus houses, while you can do that in storage, but you may have one competitor or two competitors. Mm-hmm. And you really have to measure against the quality of the facility, what they're offering, how full they are, which really makes a big difference on the price that you should be willing to pay and the kind of revenue that you can drive in that facility.
Let me ask you this. Are there websites, I would assume, that where they broker self-storage facilities, like a broker would broker houses or commercial buildings or any type of real estate, basically?
Yeah, so commercial real estate, coming from the residential side, mostly you can find that anywhere. You can Google an address and 100 sites are going to pop up to tell you about that property that house that you just Googled. When it comes to commercial property, commercial realtors do not act in the same way as residential realtors. The way that they market properties is different. There are websites. You've got LoopNet, you've got Crexy. Those are some of the big ones. CoStar. There's a lot of opportunity to just browse those sites to be able to see what realtors are offering, not just for storage, but office, industrial, land. There's just a lot of opportunities on those websites to see what's being offered. But like any other type of professional, commercial realtors and residential realtors, they're there to maximize the price for their client. And right now that's at if you're buying real estate, you're paying a premium these days for sure, especially if you're buying through something that's already been marketed by a professional realtor.
Exactly, as opposed to off market. So I want to talk a little bit about, I overheard a discussion recently, and it was about self-storage, and it was about build from the ground up versus buying an existing property. It would seem to me that these are kind of the same rules that would apply to single family homes. If a lot of times you can get a better deal on an existing home, it may need work or whatever. So what is your thought on this? Let's say someone does not have a piece of property. So they're going to buy the property. They're going to do a ground up build. Which way is the better deal? Which way is the better way to do it?
That's really the $1 million question, isn't it? So
I'm wanting $1 million answer here.
Yeah. I'll start. Let me start with this statement that self-storage, the greatest enemy to self-storage is self-storage itself. So you can buy a facility where nobody else has another facility around. You can fill up that facility, and then 5 other people in that same town have land free that they can smooth out, pour some concrete, put a building up, throw some rock down, and say, now I have a self-storage facility. So it's easy to create competition in self-storage. So there's always that risk when it comes to storage. That being said, when you go from a ground up as opposed to buying an existing, you're going to start with a raw piece of land. You're going to go through the permitting process. And right now, just like everything else, it's extremely expensive. So the cost of steel, while lumber continues to go up and down, the cost of steel has not retreated from where it started, let's say a year and a half ago. So it's doubled in value and doubled in cost, and it has not retreated back. So the cost to build is still extraordinarily high. And so when you see new builds, they're usually building them so big because at that point, the economies of scale kick in. It's worth it for them to do that. And what a lot of those guys are doing is they're either one building for themselves, or as I have a friend, he builds it with the specs and the idea in mind that he's going to sell that to one of the major self-storage providers in the US. So he will build something in an area that meet the specs that, let's say, Public Storage would want to buy. He builds it exactly the way that they would want, and then they swoop in and go, we'll buy that, and they take that down. We purchased it. Also means when he's doing that, you're not generating revenue in that facility. It takes time to generate revenue when you spend a year or longer building a facility, processing it, getting it ready. And so the profit for him and his investors aren't seen until that building is sold or filled up. That's not what we aspire for. We like to buy pre-existing facilities where maybe there is an opportunity, there's a value add of some kind. Maybe there is land for an extra building or two, and we notice that the demand is there for that product. We notice that the facility is grossly under priced, either in sale price or in rents. We would buy that, move in on that, and improve that situation. Or the operational efficiencies are just out of whack. So maybe they have their revenues really good, but they're spending 50% of their revenue on expenses, and that is also out of whack. So we look for those inefficiencies, go in, improve those, and maximize the value, because these facilities are priced or valued based on the net operating income that they're driving, not, oh, hey, here's a 3-bedroom, 1-bath. Here's a 3-bedroom, 1-bath. This one sold for 100, so this one's worth 100. In reality, you can have a facility that's not driving revenue, but over here, the same exact facility is doubling that revenue. That one on the right is worth more because it's creating more value for at the facility level. So at some point, when you're looking at these facilities and the way that every other piece of real estate has been driven up in value, and I just had this discussion the other day with somebody, at some point a line is crossed. We are happy to pay a premium for an existing facility that will immediately begin to cash flow and provide the revenue that we are looking for from that type of a facility. The value that people are wanting, or the asking price that people are wanting for that, is going higher and higher and higher. And at some point, it does not make sense to go and purchase a facility that, let's say, they are asking $100 to $150 a square foot for that facility, when I can go over here, buy a piece of raw land, and build that facility for half the cost that it takes to actually buy the other one. So if this one's for sale for $4 million, wait a minute, this is such a high price. Why don't I just go buy this $100,000 piece of land, permit it, develop it, and create it, and realize I'm only going to have $2 million or $2.5 million in it, and I just have to wait a few years before it's worth $4 million. So there's a balancing act in that. That's not ours. We like to purchase existing facilities right where we're at, do the operational improvements, or find the physical or monetary improvements that we can make, because it provides immediate return for the investors and immediately cash flows. Yes, the other, to build from ground up, you can gain a lot of equity, but like I said, we're willing to pay a premium for those where the cash flow is there right off the top. So that's our focus. There are pros and cons to doing both. We just happen to stick with the one.
That's smart. And I guess I never really thought about the value adds. That's an obvious thing if you're dealing with apartments, maybe even small commercial buildings. You always think of the value adds and the value plays that you can do with that. I never really thought about that so much with self-storage facilities, though. So that's something to think about. But I like the way you put that. There's always an amount where you have to just say, wait a minute, there's that line in the sand. It's too much. But that gives people a baseline for knowing, which way they might want to go. For me, I think all day long, something that's built is a better deal, because you've also got the lease up period. I mean, I think that can be 18 to 36 months. And so depending on your area the lease up period and on a brand new building.
It can take a lot of time. So in our analysis, we plan for 2.5% move-in monthly, which is good from the history that we've experienced. And so in theory, if we were to buy a facility with 0 occupancy, it's going to take us, we plan on it taking 3 years. So if we were to say, oh, wait, you've had this pandemic hit, you're going to see that we've had that excel. So the first facility that I was talking about earlier, we bought at 30% occupancy, and in a year and a half, we are at almost 80%. You can easily make the argument to say that our 2.5% increase is too low, but that would be, I don't think anybody would ever look and say that the last 2.5 years has been a common 2 years. So we still underwrite things conservatively to make sure that the value is there for our investors, and we're protecting against the downside. We don't ever want to be, we don't want to give the impression that we are being aggressive monetarily. We're going to really drive these rents high, and we're going to get this massive increase in move-ins, when in fact that may not be common. We want to pull back and be more conservative in our assessment, because in 6 months that may change, and we'd rather protect against the downside and say, look, we were ready for a downside from day one, not ready to bake in much higher rent increases and occupancy that just doesn't exist in a normal situation.
Plus, you look like a hero if somehow it goes the other way. I mean, let's face it, if you prepare for the slow rise and you get a quick rise, it just makes you look good. There is that.
Oh yeah. It's great when we can tell our investors, hey, we went from a facility where the 10 by 10 was $40. We raised it to $60, but the occupancy did not change when we raised it. So maybe the 10 by 10s were at 93% at $30 or $40. And we said, well, we think we can hit 60 and fill this up. And when we raised it to 60, we expected 10% to move out, and nobody moved out. Mm-hmm. So then we said, oh, hey, maybe we have some more room to grow. And we raise it to 65, 70, 75, until we reach that point where you begin to see occupancy start to drop. And we would have found the ceiling at that point in that rent increase. And at that point you stabilize and you go, okay, hey, we've hit 80. We've gotten some move outs because of that. We're not filling up as fast as we think we should now. This is where we're going to stick for now. And then what we do is we begin our basic rent increases annually. So you may have somebody move in at that $80 value, and in 6 months we do a basic 4% or 5% increase, because let's be honest, everybody's bringing truckloads of stuff to put in a 10 by 10, and for a 5% increase or $4 a month, they're not getting their buddy's pickup truck, backing it up and moving it down the road to save $10. And so you can begin to bake in those basic rent increases to further increase revenue for the facility, and then provide greater returns for the investors and increase the value of the facility.
That's so smart. And I like the way you did that step-by-step approach. And I like the way, that 2.5% lease up, that is a number that is a valuable number for people to know. It gives them a benchmark. If they're brand new to this, and you've thrown out a whole bunch of numbers that are important, but that gives them a basic understanding of what they should accept as what the probability of the situation.
Yeah, and it's very market dependent. In a southern town, you may see where there's just where you've seen this great migration, where people from the West Coast or the Northeast flocked to the South. You see cities like Nashville, cities like Austin, Miami, Atlanta. You're just seeing explosive growth in these areas, and the amount of storage necessary is growing because these people came from towns, well, especially in the Northeast, where they had basements. Now they've moved to the South where they do not have basements, or they're just moving into different areas, and they're like, where am I going to put all my stuff? And they've got to find locations. It's got to be built. It's got to be filled. And so there's just, you just have to measure that out. That growth may not be 2.5%. It may be 6%. You have no idea until you really get into it. We just feel that 2.5% is a conservative number that we've experienced in the growth that we have had in our facilities that we've filled up and raised rents on, and continue to generate revenue on in that manner.
You're always better to hang your numbers on conservative estimates. And you will rarely be disappointed if you do that, as opposed to going, hey, over here, I'm sure we can meet this ridiculous benchmark, and then you don't meet it, and then there's disaster.
Absolutely. The bodies of real estate investors are littered across the streets in 2008, who just planned on these massive increases and these massive raises, and they just kept going, and they're like, the party's never going to end. Well, eventually the party ended, and people lost houses by the dozens. They were just, it destroyed them. And so it's not, I don't think that anybody should be fooled that, the music and the party that we've had for the last, you could easily say 8 to 10 years, the music's been playing for a long time with easy capital and low rates. And now that inflation has taken off like a rocket, that the federal government is going to do their best to stamp that down. And you're going to see changes in the debt markets when it comes to that as well. And the ability to refinance at low rates, the ability to gain debt to leverage your properties is going to decrease. You're going to see some changes. And if you are just thinking, hey, these increases are coming, you just don't bake that into the equation, because in reality, you don't know what the future holds when it comes to the debt markets and what the opportunities for growth are going to be.
Yeah, that's so true. Speaking of money, I wanted to get into this a little bit. Now, I know you mentioned having partners. I guess do you have lending partners? You have equity partners? Obviously, you have a partnership. Let's talk about the financing end of this. This is a much bigger pot of money you need than a single family house. So where does someone start to think about that and get those pieces lined out before, if you can't go find the thing and then say, now I need to find the money. You have to know where you're going to get your money first. So let's talk about that.
So, as opposed to buying a distressed single family residence in our area, you could say, anywhere between $70,000 to $100,000. You're talking about $14,000 to $20,000. That's not out of reason to just knock on some people's doors who are fellow investors and begin to gather that cash for a return to that investor and say, look, I'll pay you X for this money for this long. I think that there's plenty of that money when it comes to single family. When you're purchasing a million, $2 million, $3 million asset, and you have a lender who at any given time may require 20 to 30% down, you're talking easily somewhere between 300 to, depending upon the size of the asset, $1.2 million on a $4 million property. That's a hefty lift. And so right now we've had good fortune for the last decade too. There's a lot of capital in the streets. There's a lot of people looking to put their money somewhere that is not in the equities market, in the stock market. They're looking to put it in what they believe will be a more stable long-term solution outside of stocks. And so there's a lot of private equity guys out there like us who go, hey, we're here, we're experienced, and we can put that capital to work and provide you a strong, stable return over a longer period of time. Having those inroads with that leads to then when we acquire a facility, we have those equity providers who are willing to provide that to us for what's called a preferred return and equity in the deal. And then we are then able to go to lenders, and we like to stick with small community banks in the area. There are larger lenders in the country who focus on self-storage. The SBA does, but we like to work with smaller lenders. They're more nimble. They have the ability to move a little more quickly than say that the government does with the SBA. So we like to focus on those local lenders, and you're going to find 20 to 30% down. You're looking at usually ARMs, or we've been finding a lot more balloons lately when I'm talking to lenders.
Wow.
We like to focus on that. And I made a post the other day. I was like, it's everybody needs to remember that lenders are more than just a rate that you're getting. The terms are extremely important to keep your eye on, because there are prepayment penalties, there are balloons, there are short-term rates out there. You've really got to keep your eye on that and know what your game is in the long run. Because I talked to somebody who had the most bizarre loan just today, and he said, I had a 5-year ARM with a 6-year prepayment penalty. I'd never heard of that before, but a lender plopped that in his lap, and he didn't know he was signing. He signed it, and then he realized, and this was an experienced guy, and he was staring at that after he had signed, and he realized what he'd done. And you've really got to pay attention to the terms. Just because a lender tells you it's 7 years, that doesn't mean it's an ARM. If you're facing a balloon and it's 6.5 years, the refinance market or the debt markets have frozen up, and you're facing down a balloon at 7 years, you're in a lot of trouble. You're not going to be able to come up with that cash, or you're going to sell with your back against the wall to somebody else who can buy it and say, look, you're in a tight spot and I will take advantage of that. And so you've really got to keep an eye on the terms that the lenders are providing. And so, number one, it's good to have your capital providers lined up and ready. We like to use syndications for that. And we have people who have raised their hands and say, look, I'm willing to provide X number of dollars. We just want to look at the deal before it's pushed out. And then once you have them lined up and ready to go, you just need to be able to find the financing after that as well. And we like to use the local markets for that.
So to be clear, you're using the financing for the whole deal or for the down payment the private money lenders? You're using them for the down payment or for the entire deal?
No, for the down payment. Smaller deals, you could use the whole bit. It just all depends. So when you do the syndication, you have these investors, they're looking for a certain return. You're not just saying, so we may offer an 8 pref, which is you can call it 8% on the money that they've loaned you. It's not a percentage, but they're getting the first fruits of any of the cash revenue, the cash flow after the debt's been paid. So they're going to get 8% on their money. And then whatever is left over is distributed based upon the equity that you have sold those investors who are bringing that money. So if you have easy numbers, let's say it's $1 million property, a bank wants 30%, an investor or investors say, we will bring 300,000.
Right.
based upon your pro forma and the numbers that you're bringing, you may say that's fantastic. We appreciate it. We're going to give you, and these, I don't, depending upon the sophistication of the investors, you may be saying there's value add here. We're going to give you an 18% IRR, an internal rate of return. And at year 5, that's what you will have achieved. And to get that, we are going to give you 50% of the equity in this deal. So they're getting 8% on the front, and you're giving them 50% of the cash flows. And at year 5, when they achieve that, or beforehand, as you're measuring the amounts you're paying these people, once they achieve that level of return, you're trying to get their capital back to them. So yeah, they may provide you with 30% to purchase the property, and then you take that 30% and go buy from a lend. You get debt to purchase the property, but the equity that they're getting doesn't necessarily measure against the amount of money they're providing you. It's heavily dependent upon the return that these investors are wanting for the equity they're giving to you for the deal. You just use that equity for the down payment, or maybe some of the other costs that come with purchasing that facility.
Okay.
I hope that answers your question.
Yeah, that's a very advanced answer. So yeah, I want everybody you may need to listen to that one a couple of times. But yeah, so that gives people a pathway for, here's how you do this business. You don't have to have $1 million in the bank yourself. There is a pathway to doing this with other people. It's nice if you have $1 million. It's nice for sure, but not everybody has that. So I know you hate these averages things. But I'm going to ask you anyway. So is there a range of profit, of cash flow that people can expect to make on self-storage? As we all know that houses cash flow at different rates, but different investors have. I know an investor that will not buy a property that does not cash flow at least $400 a month. He's in Chicago. Sure. He's not going to do it. And they have crazy cash flow up there, crazy cash flow. So, but is there, what is it you're looking for? What is a good return on the self-storage?
Sure. So it's a great question. And it varies. It varies dramatically.
I know that. So circle back to pick a market.
That's all right. That's quite all right. So and I can only speak for Eric and I in this instance, in that really for us to be interested in a facility at the end of a year, we would want to make a minimum cash flow to us after investors have been paid, after mortgages, we've put money in for capital expenses. We're looking at $24,000 a year. That just makes it worth it for us to operate that. It's the greater of 24,000 or 1.25% of the purchase price. So those are our minimums. That makes it really hard for us to buy smaller facilities. We really have to find that our net operating income is roughly about $100,000 to reach those numbers. So it doesn't matter how big or small the facility is, but it's the revenue that's being driven by. So for instance, you can have a very small climate controlled facility, let's say 20,000 square feet, climate control only, or you can have an extremely large outdoor storage facility, maybe 50,000 square feet, but they're throwing off the same revenue because this asset is more valuable, or it costs more rent is coming in on the climate controlled storage than it is on, say, outdoor storage or on parking. So in the end, it doesn't matter the size of the facility. We're really focused on what kind of revenue, what's the amount of revenue that's going to generate, what's going to be available after expenses, and then is that going to be able to go into our pocket based upon what we're paying to investors. And so we really focus on the greater of 24,000 or 1.25% of the purchase price. That's not to say that smaller facilities bought by individuals who are going to self-manage those facilities can be very valuable. and they can make a lot of money for those people. We are currently we hire outside management to manage our facilities, and so immediately that's costing us cash. It's just an extra expense that we take on that a lot of other people don't take on because they do a lot of self-management. We just choose not to do that. We're capable of it. We're about pushing this off to people who can operate better than we can. And so we just choose to do that. So we have set those minimums for ourselves. You find there's large operators who have their own inside management, and so they're not paying those costs. You have really small operators who may just own a facility or two. They're not paying that cost, and they can cash flow a different level than we can. So we are just we have to be very hyper specific about what we are looking to invest in because of the way we choose to operate our business. Everybody's different across the board. I'm very similar to your friend in Chicago. When I was buying single family, and when I first started, I was like, wow, I'm making $100 a month or $125 a month. And over time that grew as rents grew. But those properties that I bought when I first started investing are still the worst performers of all my properties.
Yeah.
And so after a while, what I chose to purchase was a minimum of $300 a month on my cash flowing single family rentals. I don't buy those anymore, but we already have this thesis of this is our minimum and this is what we're willing to accept. And if we come across a facility that we think is a good buy, we would find somebody else to pass that facility off to. But that's our minimum when it comes to facilities.
So for the property, 24,000, or per person, 24,000.
The total net to the beyond storage at the end of a year needs to be 24,000.
Okay.
The greater of 24,000 or 1.25% of the purchase. So, if you're at, and I'm once again trying to do numbers in real time is very difficult, but you buy a $3 million facility, 1% of that is $30,000.
Yeah.
That exceeds the $24,000.
Yeah. But that gives you a reasonable way to look at it. And I know you and your business partner, you all are very much about lifestyle. You both have small children, and I know that people go, well, you could self-manage. Well, yeah, you could, but that's not what we choose to do. And I respect you for that greatly, because at the end of the day, everything is not about saving $10 or $100 or whatever. If you're trading your lifestyle and your time with your family, if that is the expense that you're giving, what you're giving up, then get a manager if you can do that. Bake that into your numbers. So I commend you all for that.
Yeah, we're in a different position. We're on the back ends of our single family renting career. We have single family residential properties that provide revenue for us, and for us, you're right, time is more valuable to us at this point. And so we've all lost friends or we've all lost family in the last couple of years to COVID, and so we sit back and we're like, wow, you see the Great Resignation, and I believe people making a personal choice to focus on what is more valuable to them other than, say, a job, and they're either staying home with kids or they're working remotely or they're choosing to go to a different job that they really want as opposed to one that might be paying more or have different benefits. And we just kind of look at it and say, you know what, this is what's worth it for us. And so for those listeners who hear that, that works for my partner and I, but what might work for you in the beginning of your investing career is completely different. And so that just has to be measured on a very personal level to decide what you're willing to accept.
Exactly. Now, I'm a marketing nerd, so I have to ask you this question. What do you do to market these things? Other than billboards, are they on the side of a road? Do you have an ad? How do you do that?
That's a really good question. That's a very good question. We measure, so the facilities that we like to focus on, some of the other criteria that we have a minimum population that we like to see within a 5-mile radius of the facility. If it does not meet that minimum, it does not It doesn't work for us. We like to see a minimum amount of traffic passing by a facility. If it does not, that is not of interest to us, because we need the eyeballs driving by a facility, because where they live is where they are going to put they're going to use storage. So the more cars, the better. We utilize search engine optimization, SEO. We will use AdWords to Google for people when they Google online. Storage doesn't have a ton of keywords. When people are looking to sell a house, there's maybe 100 very popular keywords. Storage has very few. I mean, you can only say, find a storage unit near me in so many different ways. So we focus on that. And then we focus, there are other paid advertising ways. We utilize Sparefoot, which is a large company to advertise the availability of the units of facilities in an area that people are looking for.
Okay. Oh, that's a new one, Fairfoot. Be darned. Okay, had to write that down. So finally, Jay, what advice would you give investors that want to get started in this niche? Do you have some pros and cons, or go for it? What's your final advice?
Storage is a great business. You're going to hear a lot of people. Number one, you're going to need education. Number two, you're going to hear a lot of people tell you how passive it is. No real estate is passive. And to believe that would be to accept a fallacy. We've attempted to make it as passive as possible, but we still have to deal with move outs. We still have to deal with auctions. We still have to deal with things breaking. And so just realize that it's not passive. Two, you're going to need to know what you're doing and understand the evaluation of a storage facility. It's a complex business. You'll hear a lot of people tell you that it's real estate. It's a real estate investment. That is not accurate, in my opinion. Storage is a business that just happens to come with real estate. You are operating a business, and you're selling a product to people who will use. Maybe sometimes it's on a very short-term basis, sometimes it's on a very long-term basis. But the way that you operate it will really depend on the revenue that you've got. Nobody ever looks at it and says, well, this unit, this facility sold for this, so this one's worth this. Once again, it's not that. It's all the revenue that's being driven, and it's evaluated the way that a business is evaluated. And so you have to keep that in mind, and just realize that right now, all across real estate and in business markets, it's just a very frothy, very high priced. People are getting a lot of money for facilities, for businesses, for houses, and that the belief that may last a long time is, I believe, an error. So you have to buy right, and you have to be ready to evaluate those facilities to what you are willing to accept on them, and be conservative in your underwriting and understand where those numbers are going to lead you, because in the end, it's numbers and operations that really matter in this business.
That's great advice. I like the fact that people think real estate is easy. It's a simple business to some degree, but it's not easy. And each specific niche has its own challenges. So that was great advice to people. So what's the best way for folks to reach out to you, Jay?
Yeah, you can reach out to me. My email is jay@gobeyondstorage. Our website is gobeyondstorage.com. There you can see the facilities that we've purchased. You can find out about us. You can choose to be an investor there and sign up to receive the deals that we are pushing out through syndication. And if I'm active on Facebook, but there's really a vibrant real estate community on Twitter, and I am at Jay Bowman on Twitter. That's JayBowman.
And I'll put all those links in the show notes so that if you're looking for someone to invest with, this is your guy. If this is something of interest to you, Plus, he's a fun guy. You can probably tell that from the podcast. A little bit crazy fun.
I appreciate that. Your check's in the mail, Sharon.
Thanks for coming on the show, Jay. And thanks again to all the listeners that come out week after week. I appreciate it. Please share this show and leave us a rating and a review. It really does help people to find us. Well, that's it for today. I will see you same time, same place next week. Bye for now. Thanks, Jay.
Thanks. Thank you.